Welcome to the Hidden Money Podcast. We are coming to you with the third episode in our real estate series, and today we're going to be discussing the joys of long-term real estate. And long-term real estate is way different than short-term real estate, not only on the surface with how the actual property functions with a tenant, but on the tax side too. And we're going to spend time on both sides a little bit today. But Mike, long-term real estate, you actually own a long-term rental.
I do.
And
it's not my intention. We were planning on getting a short-term rental, but we have a long-term rental instead.
You got a long-term, and
guess what? There's tax benefits to long-term rentals, just like there's tax benefits to a lot of things. I think that's what we really want to focus on in this episode is, yes, long-term rentals provide good, steady stream of income. They're taking a lot less work than short-term rentals. There are great tax benefits there, not the same ones unless you're a real estate professional as short-term rentals are, which was my disappointment when we got a long-term rental. But we're still enjoying some pretty darn good tax advantages, and our tenants are paying for the mortgage to be paid down while the property's going up in value.
Yeah.
It's a beautiful
I
thing.
think it's a very good testament to kind of what you always say is you don't let the tax tail wag the business dog. You did not buy this long-term rental from a tax strategy standpoint, even being who you are as a human and a CPA wanting to drive down your taxes all the time.
It was difficult.
It was.
I still feel a little pain about it, but it was the right thing to do.
It was. You made a good investment. It helped your family. All the puzzle pieces were there, just not the tax side. And that's okay every now and then. If you find a good deal in real estate, we don't have to harvest every single drop out for taxes if the stars align to where you're making more money. So that's what we want to talk about today is on the long-term real estate, there's only two classifications of real estate whenever you're from the IRS's eyes. There's obviously more in the real world, but we're talking the Internal Revenue Code. So the Internal Revenue Code has either short-term real estate or long-term real estate. Both, whenever you buy a rental property, it defaults to the passive classification. And we've talked ad nauseum of kind of the importance of that. Whereas if you're a W-2 earner or self-employed, that's active income. You can't go buy passive investments and expect a tax plan passive investments with active income. So what moves long-term real estate from passive to active is it's harder than in the realm of short-term real estate. So how do you move long-term rentals from passive to active?
The only way you can take a long-term rental or any other type of real estate professional activity, there I just gave it away, from passive to active is by qualifying as a real estate professional. That's the first part of the hurdle. You got to qualify as a real estate professional. It's a lot harder to qualify as a real estate professional than it is to qualify, well, for most people, than it is to qualify for as a material participant in a short-term rental. So to be a real estate professional, a lot of people think, oh, I have to have my realtor license or I got to be a contractor. No, the IRS simply cares about one thing. How much time do you spend on qualified real estate professional activities? Qualified real estate professional activities, all right, there's 11 things stated in the Internal Revenue Code for it, but basically something working in real estate. Most common one to think about is running and operating a long-term rental or running and operating a commercial rental, being a real estate agent or a realtor. That time counts. You have to have 750 hours in a year. It's not prorated, 750 hours in a year, which is just a little less than 15 hours per week. And if you do that, boom, you've hit the first hurdle. Kevin and I can do that. As a matter of fact, I think I probably did that last year with ours. The problem is the second hurdle to be a real estate professional. At the end of the year, you have to count up all your real estate professional time. Again, it's got to be over 750 hours, but it also has to exceed all of your other combined professional time. So as long as Kevin makes me work as hard as we do at the firm, I figure it's about 2,500, 3,000 hours a year doing non-real estate professional work, doing the fun stuff, tax stuff.
Yep.
I'd have to work 3,001 hours as in real estate professional activities to qualify. I can't do that. Husbands and wives can't combine their time to qualify as a real estate professional like they can to qualify as a material participant. So that's hurdle number one. You got to qualify as a real estate professional. But that's not the only thing.
Yep. The other thing is, let's say you're a real estate agent full time, and that's what you do for your living. You buy or you broker real estate deals on behalf of your clients. You're a real estate professional if you're 1099, if you're commissioned. Or if you're a W-2, the water's getting murky a little bit on the W-2 side. But from a realtor standpoint, let's say you're a real estate professional and you meet the guidelines. You could own 2 or 3 long-term rental properties and you're a real estate professional, but you still have to manage those properties. Those properties are still passive. Real estate professional status does not just make all your long-term rentals active income. It's the first step. The second step is you have to actually materially participate in the long-term rental properties. So being a rep alone doesn't do that. It's your material involvement in the rental properties. And there's some relief in the code for grouping your long-term rentals.
Oh, I love that. Right?
Yeah, and so let's say you have 5 long-term rental properties. Hitting material participation on all 5 might be kind of hard. So you can make an election on your tax return, group all 5 of your long-term rentals together for material participation purposes. And as long as you materially participate on the group, then all of the properties in the group are subject to material participation.
Yeah, let's talk about that grouping election for real estate professionals. It is a beautiful thing for real estate professionals to be able to group activities together for material participation tests. It's a lot easier on them than it is so many other professions or in so many other different areas, including short-term rentals. There's an election that just says, hey, if I am a real estate professional and I materially participate in one real estate professional activity, I can file this election on my tax return to group all of my real estate activities together, not just other long-term rentals that you might have that you're passive in. Let's say you invest in a syndication that you truly are passive in. You put money into syndication, they go buy an apartment complex, they send you a K1 with a whole bunch of bonus depreciation. For most of us, that's passive depreciation. If you're a real estate professional and you materially participate in one activity, you group those together and now you've got passive money working for you in syndications that are providing you active depreciation. That's a sexy thing.
It is, and there's a downside to grouping, especially if you're utilizing passive losses. I don't want to get too technical in there. I really want to just state every tax situation is so different and complex. Rep status is something, there's a lot of details involved into it, time, your job, and all these other things. And then when you group, you have passive activity loss issues. Grouping election is very good, but it just may not fit everybody. But majority of people out there, if you're trying to actively reduce your tax bill through the long-term rentals you have, it's a good deal. But
think of it as a tool that's available to you, but be very careful how and when you use that tool. I mean, we've looked at clients that have 30 different activities, and you got to figure out and try to have a crystal ball. Which ones are we going to sell? What's the activity going to look like over the next couple of years? And we might make 4 or 5 different grouping elections. Like Kevin said, every taxpayer has very different facts and circumstances. So again, this is just general advice, but man, it's cool to be able to do it.
Yeah. Because, I mean, a big part of the real estate professional, or not real estate professional, but owning long-term real estate is if you have other passive income, I'm not worried about active. Mm-hmm. Let's say you have a lot of passive income. Go passively buy as much long-term real estate as you want. It doesn't matter because we're going to be reducing that passive income you're bringing in. It's in the same category. The issue you get with grouping is if you have 5 rental properties grouped, and then there's passive losses tied in there, and then you sell one of the properties, then you're going to start seeing some issues with releasing those passive activity losses against your other income. But
well, it's just an example. We had a physician a few years ago. I'm sure I'm going to murky some of the actual facts up, but this had like 6 or 7 real estate properties. A spouse was a real estate professional, and they wanted to group them, and they had grouped them before they came over to us, all as one activity for material participation, claiming they materially participated. But then that physician invested in a surgery center that was spinning off passive income to them. And we wanted it to be passive for a lot of reasons, SE tax, other reasons. We wanted it to be passive, but he had all those properties grouped together under active material participation. And we had to do a lot of basically tax jujitsu to get some of those out to be able to eliminate his taxable income from the surgery center. And that's a perfect example of passive income. So for me, in my real estate professional activity, our long-term rental, I'm keeping that where it's at and going to utilize those losses from depreciation. I'm saving my cost seg for when I need it. I'm going to take those when I have a year of passive income that's impacting my tax return.
Yeah, and we haven't gotten to the point of why do I want my rental properties from passive to active, but you just hit on it, cost segregation. We're also going to bring to you purchase price allocating and what that looks like. We're going to do that in the next episode. So we're going to tell you kind of why. Why do I want my long-term rentals as active in the same classification as my W-2? Well, next episode, we're going to go over that because there's just tremendous tax benefits to doing that.
But I think the point we're trying to make is there are very good tax benefits in real estate professional activities, and particularly long-term rentals. Why would you want to go buy a single long-term rental versus go invest in the stock market or go give your money to some syndication? I can think of a lot of reasons. For me, it's about control. You actually have a physical asset. You have real property. They're not making more land out there, except occasionally when the volcanoes grow Hawaii or something, but they're not making more land. It's a finite resource. It goes up in value, and it's a physical asset you have. It's not some ETF, which could be good, could be bad. It's not money that someone else is managing that could make some bad choices and lose it all, or be over leveraged like we've seen a lot of syndications hit in the last 5 years as debt interest rates gone up, insurance rates gone up, especially on multifamily housing. We're seeing a lot of those syndications taking a dump. If you just had one single family residence at your long-term rental that you put that same amount of capital in, it's still there. And it's going up in value. It's a safe investment. It's a way to diversify your investment.
It's good debt too. It is secured by the property. If you put enough down on the property and you're not upside down just immediately, or you alleviate some of that market risk of the real estate market fluctuations, put enough down to where you have the equity up front, you're not pressured to sell, and that you can cash flow on a monthly basis. You need to do your analytics and make sure these numbers actually run. So, but I love it because it's secured debt. It's good debt. You get to deduct the interest that you pay. Typically, the interest is lower depending on your credit and your history and everything, but typically your interest rates are going to be fairly low, and it's all going to be tax deductible. And it's secured by an asset you're in control of, and you can kind of trigger when you sell it. Now, the market conditions could be weird. It might not be the right time to sell, or you could find yourself in a situation where the market's just not calling for sell right now. Like being in Texas, we just have so many builders. Like they're just building property everywhere. Yep. So the resale market's kind of hurting just because why would I pay for a used home when I can go to a builder and we have so much land and they're just scooping it up for
but over time, you're almost guaranteed it's going to go up in value.
It is. It is.
That's one of the beautiful things about real estate.
People always need housing. It's like invest, like if you're going to invest in a stock, invest in Colgate. People are always going to brush their teeth. Buy some homes. People always need a place to live. Look at those resources that are always going to be needing something from the general population that you can always count on.
Hope you're enjoying this episode of Hidden Money. I want to remind you that not all tax preparers or tax advisors are created equal. As a matter of fact, most CPAs out there are just tax preparers. Do you want a tax advisor? You probably need one, or at least a good tax strategist. We have a great firm at Revo Taxpayer Advocacy that can help you. We offer free consults. Just go to our website, revotaxpayer.com, click the button, and talk to Kevin and I, and let's see how we can change your life by saving your taxes. Let's talk about the debt part for a minute, because like Kevin and I both say, it's what we consider good debt, healthy debt. It's backed by that property. So if you sign a normal mortgage, and not all mortgages are created the same, but you sign a normal mortgage and let's say things just get rough with you. You lose your job, someone gets deathly ill in the family, your cash flow hurts and you can't make the payments. 9 times out of 10, the worst case happens is you get that property foreclosed on, or maybe you have to short sell that property. They're not going to come after you for your assets. They're going to just take it from that asset. So it's safe compared to a lot of other riskier debt that we would call it. You also get a fixed rate mortgage. I don't consider it good debt if it's debt that is a variable rate, because granted, for the last 10 years, people call me overly conservative, saying you got to get fixed rate. And we saw a lot of people just go buy those variable rates, but now they're hurting. They're hurting bad, especially last year when interest rates were up at 9%. I mean, suddenly a cash flowing property doesn't cash flow. But it's good debt. From a perspective of tax benefit, though, again, don't let your tax tail wag your business dog, but purely from a tax perspective, the more debt you get, the more you leverage on that property, the more you're using the bank's money to get your tax benefits, to get your tax deductions, and the more you're using the bank money to go up in value for fair market value appreciation. So think about it. If you buy $1 million house and you pay all cash, and over the next 10 years, it goes up to $1.5 million. You put $1 million in, you sell it for $1.5 million, you made 50% over 10 years. But let's say you buy that same house 10% down. You put in $100,000, and then you turn around and sell it for $1.5 million 5-10 years later, and you've now made $1.4 million, or at least you've greatly leveraged your return on the assets. So that's another good reason about it.
Yeah, it is. You can the leveraging is good. I'm always cautious on over leveraging, just because you don't want to wake up 10 years from now and you have 10 rental properties and you just kind of accumulate and account for all your debt and you're like, oh my God, how much in debt? That
And all
could
your
be
cash
risky.
flow is going to pay off the debt.
All your cash flow is going there. So you got to balance it. And, we're big advocates in oil and gas, but I tell my clients all the time too, don't be over leveraged in oil and gas. It's great for taxes. We will invest that money. We will grow it the best we can, and we'll get you a tax return on that, a tax deduction that's deductible. But you don't want to wake up 10 years from now either and be like, I have how much tied up in oil and gas, and it's just crazy. So you want to be a true diversified good investor to where you do have long-term, short-term real estate. You can diversify even in the geographic location. You can have, an urban home, a beach house, a mountain house. You can do different regions. If all your real estate's in New Orleans and a flood happens, that's trouble. Yeah. You want to be smart about what you're doing out there. But we're huge advocates for everything, real estate, oil, whatever it is, just diversify it.
Absolutely, just diversify. I want to go back to my long-term rental because I think it also shows the lifestyle side of investing in real estate. And it's still a good investment, still saving me taxes. But what happened is my wife and I were planning on buying a short-term rental. We'd saved up a bunch of dry powder and we're ready to pull the trigger on a short-term rental. My wife's parents, my in-laws, lived up in Coeur d'Alene. We didn't have any family close to us, and they were getting up in age. They wanted to be around our kids, but they did not want to sell their dream retirement home up in Coeur d'Alene, Idaho, and I don't blame them. But we wanted them down here. So as we were walking by this house doing trick-or-treating with my mother-in-law, she loved a house that she saw was for sale. And we asked, hey, if we were to buy that instead of a short-term rental, would you move here? And I got her, man. She said yes.
Crazy
they've been
proposition.
wishy-washy. Like, why would you want to leave Coeur d'Alene, Idaho retirement life to come to hot, flat Texas, right? I mean, obviously to be near my kids, but that wasn't just enough. So they've been wishy-washy for about 2 years, but I locked her in. She said yeah. So we went to go buy it. But then I didn't practice what I preach about leveraging as much as I could, because then I knew instead of buying a long-term rental where I'm going to maximize my rents every year and up them, I have to still rent it to treat this as a business. I have to rent it to my in-laws at market rent. Otherwise, it's not considered a business. I'm not allowed to take the tax deductions related to it. But there's a wide range in market rent. I'm just going to say this because this is on video. My in-laws might say it. I would never maximize their rent. I'm going to charge them the bare minimum to be market rent and not charge them that high end. But I wanted to make sure that as that lower end of market rent, as the delta grows between those over the years, that I was going to be able to service the debt. And it hurt and pained me because when I was going to buy a short-term rental, there was no way we would put more than 10% down. But in order to make sure that if my in-laws can only rent their house 6 months out of the year, they have to miss a month in rent. If I need to keep rents lower at the very bare minimum, I wanted to make sure I wouldn't have to come out of pocket to pay that debt. So we did 40% down on this loan, which still hurts thinking about it. But then I know for sure it's safe debt. The rent's going to always pay for it. I don't have to maximize rents every year to do it. It was safe, and I still get good tax benefits. And when you do that, we have a lot of people, like clients, that go buy a long-term rental near where their family lives. They want to be able to go visit their kids or visit their grandkids. If you have a long-term rental or real estate property that you're owning and operating as a legitimate business, it's an ordinary and necessary business expense to go check on that property once or twice a year. So suddenly your plane tickets and your travel are tax deductible, or your mileage is tax deductible. There's other things like that that get tax deductible.
And you're walking distance to your house, so you can deduct your tennis shoes or your shoes.
I haven't tried that yet. I haven't tried that. So, but there are things that we do benefit from, but I'm not going to give the IRS an audit trail here on video.
Yeah. You can't deduct clothing, by the way, unless it's specified clothing for your industry and that it's required.
There's always a way to deduct clothing. You just have to find the good reason for it. But like you said,
Fair.
ordinary and necessary.
There's always a way with you.
So what else do you like as we close up the whole concept of long-term rentals, Kevin? Why would you pick a long-term rental if you were growing your real estate?
Me and my wife were actually thinking about this. My wife has a history in property management. She managed apartment complexes prior to us having kids and what life entails. So she has a history of understanding how to run a property, how to deal with the tenants, how to get it, turn it and all this kind of stuff. So it kind of fit in our wheelhouse to get her rep. Just life got in the way. So our goal was, I like the security of it. The security of a long-term rental. I'm going to get a year-long lease. I'm not going to have the seasonal fluxes of a short-term rental, and I can still harvest the tax benefits using my wife's rep status was the plan. It just didn't fall through. It fell through. But I love the stability. I could get predictive cash flow. If we have you get a savings account for the repairs, an HVAC's going to go down, there's going to be a leak or whatever. I mean, it's owning a home. Stuff's going to happen. Being the landlord, that's on you. You can't go charge your tenant repairs for a property they don't own. So make sure you have that cushion in there, but take a piece of your rents and put it in there into a savings account, and you're ready to go. And I just love that security, whereas the short-term rental, it's a lot easier to get those tax breaks, but you are touching that property weekly, if not daily.
It's got a lot more wear and tear on it.
You don't know who's going in there. There's people throwing keggers in your house, wrecking everything. And you can vet these long-term rentals, get the rental app, do background checks. And I think you do that on Airbnb. I think Airbnb, I don't know, maybe not. You don't do background checks, I guess. But you know who your renter is. Whereas in an Airbnb property, people are just coming in and out, having people stay. Who knows what's happening? So the wear and tear. So I like that you're getting that steady cash flow just like you are. If I can just service the debt, I'm not making my cash flow today, but I'm betting on the real estate market in our area to keep going up, and then someone's servicing the debt for me. All of a sudden, my debt is going down and the value of my property is going up. That keeps getting bigger and bigger and bigger, and over a 10, 15 year, you're going to double your money.
And generally, you only have to put 20 to 25% down on long-term rentals, again, with good solid debt. So that means 75 to 80% of the value that's growing in that fair market value is on the bank, but they don't get the benefit of it when you sell it. You do.
Yeah. And I'll tell a quick client story. I didn't get their permission, so I'm not going to say their names. They are realtors, husband and wife realtors. They actually have their own realty company, so they are their own S corporation. But they came to us and they had probably 6 or 7 long-term rentals, I forget. And they'd never done any tax planning before. So even if you're a real estate professional and you own some long-term rentals and you've never done the strategies to utilize the cost segregation and bonus, they came to us. We did cost segregations on 6 properties in 1 year, eliminated all of their tax.
Remember, they thought you were a genius, and you're like, but how did you not know about this?
You're a genius when your other CPA's a moron.
Easy now.
But we were able to eliminate all their taxes that year. The next year, they had some loss carry forward. Then we did some charitable strategies. Their tax rate went from, and they're good realtors. Like, they're making $800,000-900,000 a year in their company. They're selling high-end properties. We're getting their tax rates in the 20s, if not below, by doing this. I mean, 1 year, I think they were probably in the teens, like low teens, like 13, 14%, and making that money. So
That's
it's
beautiful.
It is great. And so there's always ways to go. You can't go back in time, but we could utilize the current tax year and harvest tax benefits, and we can structure things in a way. So if you're a real estate professional out there and you own some real estate, reach out to us, because there might be a way to actually take those deductions currently this year.
That is another option that we've seen a lot of professionals do, as Kevin was mentioning. If it had worked out for his family and his wife, if she could have become a real estate professional and used that designation on their tax return, their joint return, to offset taxes from his income. Because again, it's hard. If you got a full-time job, and it's not in the real estate world, it's hard to become a real estate professional. But if you have a spouse that, according to the IRS, doesn't have a job. Now, my wife is a stay-at-home mom, and if you tell me she doesn't have a job, I want to slap you. But the IRS says she doesn't have a job, even though she's homeschooling and raising 3 kids. She has the opportunity to be a realtor or a real estate agent or something to become a real estate professional. And then we could cost seg that long-term rental. But my wife doesn't want to do it. Your wife doesn't. We're not going to let the tax tail wag our family dog.
Could you imagine the stress in our house? I'm like,
no.
We have 2 rental properties
It's
our
not
wives are
worth it.
managing, driving all of our kids around.
No, it's not worth it. But we have seen a lot of our clients where one of the spouses became a real estate professional and greatly offset their taxable income for a few years.
Heck yeah. There's tremendous benefits.
So there you have it. There is hidden money in real estate in the tax code. Good stuff in there, and it's a great investment. That's what we focus here on at Hidden Money. Please like and subscribe, and see you next time.